April 2020, Quibi launched with nearly $1.75 billion in funding, backing from every major Hollywood studio, and a promise to redefine how people watch video on their phones. 7 months later, it shut down. By December, its assets were sold for a fraction of what investors had put in. The collapse wasn't caused by a single scandal or technical failure. It happened because the company built precisely what it intended to build. This took less than a year. At its peak optimism, Quibi wasn't a scrappy startup. It was a fully capitalized media operation. Founded by Jeffrey Katzenberg, former chairman of Walt Disney Studios and co-founder of DreamWorks Animation, and led by CEO Meg Whitman, previously of Hewlett-Packard and eBay, it entered the market with credibility and connections. The pitch was simple: premium, Hollywood-quality shows delivered in episodes under 10 minutes, designed specifically for smartphones. They called them quick bites. Mechanics were deliberate. Quibi would commission high-production series, action thrillers, comedies, reality shows with recognizable actors. Episodes would run 7 to 10 minutes. Users would pay $4.99 per month with ads, or $7.99 without. The technology included a proprietary turnstile feature that reformatted video seamlessly between portrait and landscape. It was built for commuters, people waiting in line, moments between meetings. Short, structured, cinematic. And the company locked up supply early. Before launch, Quibi had committed more than $1 billion to content production, securing deals with major studios and talent agencies. The structure resembled traditional television economics: large upfront payments, tightly controlled distribution, premium positioning. The assumption was that there existed a gap between amateur short-form video on social platforms and long-form streaming on services like Netflix. Quibi would occupy that space. The hidden fragility was embedded in that assumption. Short-form video already dominated mobile attention, but it was free, infinite, and socially embedded. Quibi's bet was that production value alone could convert behavior into subscription. By early 2020, the competitive landscape was crowded but stratified. Netflix, Amazon Prime Video, and Hulu competed on breadth and scale. YouTube owned open video. TikTok was growing rapidly with user-generated clips measured in seconds, not minutes. None were offering premium scripted content in sub-10-minute increments behind a paywall. That gap looked strategic. It also looked manageable. Short episodes meant lower production risk per installment. Mobile-only distribution meant no need to compete for living room dominance, and the leadership team had navigated platform shifts before. Katzenberg had overseen animation's transition into global franchises. Whitman had scaled digital marketplaces. The external shock arrived weeks before launch. In March 2020, COVID-19 lockdowns began across the United States. Commutes disappeared. Waiting rooms emptied. The idle mobile moments Quibi had designed for were replaced by extended time at home, often in front of televisions. It was an abrupt behavioral shift. But this wasn't immediately fatal. Streaming usage surged during lockdowns. Entertainment demand rose. In theory, more screen time meant more opportunity. The problem was context. When audiences had time, they chose longer narratives, limited series, films, binge sessions. Quibi's core design, quick episodes meant to fill fragmented time, no longer matched the rhythm of daily life. Still, leadership assessed the situation as temporary. At launch on April 6, 2020, Quibi offered 50 shows. Within weeks, it had released hundreds of episodes. Marketing spending was estimated at over $100 million, saturating podcasts, billboards, and digital ads. The expectation was that awareness would translate into trial. Downloads reached 1.7 million in the first week. By the end of April, daily downloads had fallen sharply. Internal targets reportedly aimed for 7 million subscribers in year one. After 3 months, Quibi had approximately 910,000 active users, many still in free trials. Conversion lagged. The initial response was tactical: extend free trials, increase advertising, accelerate content releases. None of these addressed the structural tension. Quibi's shows could not be easily shared. The platform restricted screenshots and screen recording. Episodes couldn't be watched on televisions at launch. There was no native social layer. This was intentional. The model prioritized subscription value over virality. Meanwhile, TikTok's daily engagement climbed. YouTube creators continued publishing free serialized content. Netflix released Tiger King in March 2020, dominating cultural conversation with long-form episodes exceeding 40 minutes. The market signaled something clear. During uncertainty, audiences gravitated toward depth or community, not fragmented premium clips. Quibi adjusted slowly. In May, the company announced plans to support TV casting through AirPlay and Chromecast. That feature had been absent at launch by design. The product was meant to be mobile exclusive. The pivot diluted differentiation without creating advantage. Watching a 10-minute episode on a 65-inch screen emphasized its brevity rather than its quality. Financial commitments compounded pressure. Because Quibi had paid up front for content, it carried heavy fixed costs regardless of subscriber growth. The reported production budget of $100,000 per minute placed some series near the cost structure of prestige cable dramas. But unlike traditional studios, Quibi retained limited long-term ownership leverage. After a set exclusivity period, rights would revert to producers. The burn rate was significant. By mid-2020, the company had spent hundreds of millions on content and marketing, yet subscriber revenue remained marginal. Unlike Netflix, which could amortize content costs across a global base of over 180 million subscribers at the time, Quibi operated without scale. Each new show required new acquisition spending. There was no back catalog to anchor churn. In June, reports surfaced that certain high-profile shows had drawn fewer than 100,000 viewers per episode. The data was not catastrophic by television standards, but disastrous for a subscription service seeking rapid growth. Some programs generated little cultural footprint despite recognizable actors. The design that prevented piracy also prevented momentum. Another constraint emerged from platform economics. Apple and Google collected up to 30% of subscription revenue through their app stores. For a $4.99 ad-supported tier, the margin after platform fees and content amortization was narrow. Quibi had structured itself like a studio, but distributed like a startup dependent on gatekeepers. 3 months in, strategic options narrowed. Raising additional capital in mid-2020 would have required demonstrating traction. Acquisition discussions reportedly occurred with larger technology firms, but no deal materialized at acceptable valuations. The company's valuation at launch had been near $1.8 billion. Market confidence was eroding. In July, Quibi announced it would explore strategic alternatives. Internally, layoffs began. Marketing budgets were reevaluated. Content pipeline slowed. None of these actions addressed the core issue. The product sat between categories: too expensive to be casual, too brief to be immersive, too closed to be social. The point of no return likely passed quietly, sometime during the summer. By September 2020, app rankings had fallen out of the top tiers. Subscriber growth plateaued. The free trials expired for many early users, and retention proved weak. Without scale, advertising revenue on the lower-priced tier remained negligible. On October 21, 2020, Katzenberg and Whitman announced that Quibi would shut down. They cited the unprecedented circumstances of the pandemic, but also acknowledged that the idea itself may not have been strong enough to justify continuation. The company would wind down operations and return remaining capital to investors. It had lasted just over 6 months post-launch. In total, investors had committed approximately $1.75 billion. When Quibi's content library was sold to Roku in January 2021 for less than $100 million, the discount was stark. Roku rebranded portions as Roku Originals, distributing them free with ads. The assets survived, the system did not. Most employees were laid off. Ongoing productions were halted or sold. Subscribers received refunds for prepaid periods. There was no protracted bankruptcy battle, no public feud. The shutdown was procedural. By early 2021, the Quibi app had been removed from stores. What disappeared was not just a company, but a theory about how attention could be segmented and sold. Quibi assumed that if professional storytelling were compressed into smaller units, it would fit seamlessly into modern life. Instead, modern life had already optimized short attention through platforms built on participation and sharing. Premium production alone could not replace network effects. For decades, Hollywood controlled distribution through scarcity and scheduling. Quibi attempted to repackage that control for mobile screens, preserving tight ownership and limiting circulation. But by 2020, distribution power had shifted towards systems that encouraged replication, remixing, and frictionless sharing. The failure unfolded quickly because the mismatch was structural. When behavior changed, even temporarily, there was no flexibility in the model. Costs were fixed, episodes were pre-produced, the interface was closed. Competitors did not need to respond. They simply continued scaling models aligned with user habits. Quibi did not collapse from chaos. It executed its plan precisely. The environment had already moved on.